So now we've gone over the basic points. You understand what a call and put option is, you understand moneyness, and you've understood over the counter versus exchange traded. The next step is to talk about different types of options. So here is a list. Very broadly speaking, we have financial options, options on futures, and commodity options. In this reading, most of our focus will be on financial options. Stock options are the simplest sort, and I have in a sense already talked about this. We can also have an option on indexes or indices. We can have options on bonds. We can have interest rate options and currency options. And most of the focus now will be on these two types. And even in Pakistan, these are the two most commonly used options. Options on futures and commodity options, I'll very briefly describe these, but it's really not in the level 1 scope. But an option to get into a futures contract would be an example of this, and an option on commodities would be where, let's say, PIA, which is a major consumer of oil, might get into a contract, an options contract, where it fixes, or at least it gets into an option to buy oil at a certain strike price. So whenever we have options where the underlying is a commodity, that's called commodity options. Again, these are actually discussed in detail in level 3. So let us now talk about an interest rate call option. In an interest rate call option, essentially the owner of the option, which is also called the long party, has the right to borrow a certain amount of money at a given interest rate. Now the strike price here is interest rate. So let's say that the strike price is an interest rate of 5%. Now here is the sort of detail. I am going to talk about this in the context of a European option, and that's what you really need to know. So let's say that today is 25th March and you have an option, you get into an interest rate call option which matures on, let's say, 30th June. Now a strike price of 5%. In addition to the strike price, we also need to specify a notional principal, and let's say the notional principal is $1 million. Now what is this saying? What this is saying is that the long party, or the owner of the option, let's say we get into this option contract on day 0 over here. So by getting into this contract, the owner of the option, or the long party, has the right but not the obligation to borrow $1 million at a rate of 5%. So that is the exercise. The exercise price here represents the rate at which the owner of the option, or the long party, can borrow. Now obviously, when we come to 30th June, and let's say that the interest rate on this date is 4%. So notice that the interest rate here is less than the exercise price. Then the option will expire worthless, because the owner of the option can go and borrow the $1 million at the market rate of 4%. However, if the market rate of interest is 6%, then the owner of this option will exercise the option and borrow the $1 million at the strike rate of 5%. So as you saw earlier with the simple example on stocks, the call option is in the money, or it's useful, if the strike price is greater than the market rate of interest, which we denoted by S. And again, if we were to draw a payoff diagram for a interest rate option, the x-axis would be the rate, and there is the certain strike, which is in our example, that's 5%. So this interest rate call option has a positive payoff if the market rate is greater than 5%. On the other hand, if the market rate is less than 5%, then the interest rate call option is out of the money and there is no payoff. Another way to think about this is, when we talk about interest essentially is the cost or price of borrowing money, and essentially we have locked in that price of 5%, or we have actually ensured a best case scenario. So we have said that we have the option to borrow at 5% or option to pay 5% for borrowing money, and clearly we need to specify how much money, which is the notional principal. Now the advantage of an option over, say, a forward rate agreement, the advantage of an option is that you exercise this option only if it suits you. So you will exercise the option only if the market rate is high. If the market rate is low, then you will not exercise the option and you will simply then go to the market and borrow at a lower rate. In a forward rate agreement, you are contractually obligated to live by the rate that is specified in the forward rate agreement. Now let's talk about the interest rate put option. Now, just as a quick refresher, what did the put option mean? The put option is the right to sell, but we are talking about interest rates. So what does sell mean? We are talking about selling money. So selling money essentially means lending money, and what is the price of lending money? That is the interest rate. So if we have a strike price on an interest rate option equal to 5%, and let's say we own or we are long on this interest rate put option, then we have the right to lend money at 5%. Again, there needs to be a certain notional principal, which let's say again is $1 million. So if we have an interest rate put option with a notional principal of 1 million and a strike price of 5%, this means that we have the right to lend 1 million at 5%. So what will the payoff diagram for an interest rate put option look like? Again, the x-axis is the rate, the y-axis is the payoff. Now let's say this is the strike price of 5%. If the interest rate in the market on expiry is more than 5%, then does the right to lend at 5% give us any benefit? The answer is no, because if the market rate of interest is say 6%, then we would simply lend $1 million at the market rate of 6%, and the interest rate put option would not be useful. In other words, if the interest rate is more than 5%, then the interest rate put option is out of the money. However, if the market rate of interest is 4%, then our benefit is 1%. Why? Because the market rate of interest is 4%, and because we hold this interest rate put option, we have the right to lend at 5%. So that 1% difference is the benefit that we are getting because we have this payoff option, because we have this put option, and so our payoff is 1%. Taking this all the way back, our maximum payoff is 5% if interest rate goes down to 0, because if interest rate is 0 and we have the right to lend money at 5%, then our benefit is 5%. In terms of calculating the actual dollar figure, we simply multiply the percent by the notional principal. So this, in very simple terms, is our interest rate put option. Now we are going to see that, or we are going to show that a forward rate agreement is equivalent to a long call on a, so this is a long call on an interest rate option. So forward rate agreement is equal to long call plus short put, and again remember on the right hand side we are talking about interest rate options. So first let's just recall what a forward rate agreement is. This is an agreement between two parties, let's say between us and another party, to borrow money at a particular rate. So here let's first draw the payoff for a forward rate agreement. So let's say that we get into a forward rate agreement where the agreed forward rate is equal to 5%. So we've agreed that 3 months from today we will borrow a notional principal of say 1 million, and the agreed upon rate is 5%. So let's say we have 5% over here, and let's look at the payoff for this forward rate agreement. The x-axis represents the rate. Now we are getting into an agreement. By being long on the forward rate agreement means that we are the party that is going to borrow money. So we are borrowing money. Contractual, the contract rate is 5%. Now what if the market rate on expiry is 6%? Do we benefit or do we lose? Since we are long, we actually benefit. The way you can think of this is, our contract gives us the right to borrow money at 5%, and the counterparty has to lend us money at 5%. So even though the market rate of interest is 6%, but because we have that contract, that forward rate agreement, we borrow at 5%. So our benefit there is 1%. And in fact, the higher the market rate, the more the benefit to us. So if the market rate had been 7%, then our benefit is 2%, because we would still borrow the money at 5%. But what if the market rate of interest is less than 5%? So what if it is 4%? Then we actually lose. As the long party, we lose, because if the market rate of interest is 4%, we, per the forward rate agreement, still need to borrow at 5%. And this is a critical difference between a forward contract and an option. In a forward contract, as the long party, we still need to pay 5% even though the market is offering 4%. So we don't have an option here, and that is implied in the name itself. So it is a forward contract to borrow at 5%. If the market rate is 4%, we still need to pay an interest rate of 5%. If the market rate is 3%, we still need to pay 5%. So then our loss will be 2%, and so on. So notice this straight line. So this is, unlike options, this is not one-sided. If the rate is higher than strike, we gain. If the market rate is less than the strike of 5%, then we lose, as shown by this negative payoff. This point is the 0 point. So here we have a negative payoff, here we have a positive payoff. It all depends on what the market rate is when the contract expires. Now let's get now to the right hand side of this equation. We are saying that a forward rate agreement is a long call plus a short put. Another point about an FRA is that, remember from our earlier lecture, we don't pay any money to get into a forward rate agreement. Let me just label this as a forward rate agreement. Now let's look at the payoff for a long call. So the long call will be in blue. So this is an interest rate option. Let's say that the strike price on the long call is 5%. The payoff, as you've seen before then, would look something like this. So we'd have this, and then it would go up. So it would track the forward rate agreement. So let's say that we pay a certain fee, and just for simplicity, let's say that we pay a $10 fee. So that's a loss or a money out of let's say $10 to get into this long call position. And as you saw earlier, with a long call, so interest rate call option, long position means that if interest rate is more than 5%, then we would exercise the option and we benefit. So if the interest rate in the market is 6%, we have a benefit of 1% because we still have the right to borrow money at 5%. So the benefit is 1%. If the interest rate in the market is 7%, then our benefit is 2% because we will exercise the right to borrow money at 5%. But what if the interest rate in the market is 4%? Then the call option is worthless because we will then simply go to the market and borrow money at 4%. So we will obviously not exercise the interest rate call option. So this blue then represents our long call. Now let's also look at the short put. So this will be in green. Now let's say with the short put also we have a strike price of 5%. And what's a put option? The put option is the right to sell. But we are talking about the short position. So if I were to just do the payoff again on the right hand side for a put, let's say that we'll first do the payoff for a long put and then a short put. So a long put will look like this. Remember that if this is our strike price, the x-axis is the rate, the y-axis is the payoff. So if you recall, the long put has this payoff, which means that if you are long, you have the right to lend money at say 5%. That right to lend money at 5% is useful if the market rate is less than 5%. Now that's your position, which is long. But what about the short guy? So the short will actually be the mirror image of the long. So this is the short put. Why? Because if the interest rate is say 4%, then the short party is obliged to borrow money from you at 5%, even though the market rate is 4%. So clearly there is a loss to him, which is shown by this. But why would the short position get into this state? He would get into this state because to sell you the put option, the short must have charged you a premium. And let's say that he charges you a premium of $10. So the short party sold you the put option and charged you a premium of $10, hoping that interest rates will go up. But it turns out that interest rates go down, in which case the short loses. So if the interest rates go below the strike rate of 5%, then you as the long party gain, but the short party loses. And what if interest rates turn out to be higher than the strike price? Then obviously you as the long party will not exercise the put option, so the short party does not have to make any payment. So he will have charged you the $10 premium, so the short party will be happy if the rates end up being higher than the strike rate of 5%. Now let's just take this part, which is let's just take the payoff for the short party and bring it over here. So notice that the short party payoff looks like this. So this green line now is the short put, and this is all I'm showing here is exactly the payoff for the short put, where if interest rates are less than 5%, then the long put benefits, but if you've taken the short put position, you lose out if interest rates are less than the strike price. And as I mentioned earlier, to get into to take a short put position, you charged the other party $10. So notice now, you paid $10 to take a long position on the interest rate call. You charged $10 to issue or to write a put option. So the fees balance out. So effectively there is no cost here in my simplistic example of this combination, long call and short put. And if you add the blue line, and which represents the long call, and the green line which represents the short put, then we have essentially the same payoff as a forward rate agreement. And for emphasis, I am going to write this again. So our forward rate agreement is equal to the long call plus the short put. Now, even if you don't fully remember this whole explanation, as long as you remember this simple equation, a forward rate agreement, and remember implied over here that this is a long position in a forward rate agreement. So the forward rate agreement is equal to a long call, so a long position in an interest rate option plus a short position in a interest rate put option. So now we are going to show how an interest rate cap is equal to a series of interest rate call options. Now this ties back to what we studied in fixed income securities. If you recall, we talked about this concept of a floating rate bond. Now say you have issued, so let's say that you issue a floating rate bond with with let's say, it's just to keep things simple, let's say it's a 3-year bond, 0, 1, 2, 3, and let's say that when you issued the bond, the interest rate is equal to 10%, and that means that at the end of period 1 you have to pay 10%. The amount that you pay at the end of period 2 is based on the interest rate at the beginning of period 2, and the amount that you pay at the end of period 3 will be based on the interest rate at the beginning of period 3. Now, if this is simply a floating rate bond, and let's say that at the end of period 1 the interest rate is 11%, then that means so essentially that means at the beginning of period 2 the interest rate is 1%. So for period 2 you need to make a 11% payment, and then for period 3, let's say the interest rate is 12%. That means that your coupon payment then, since this is a floating rate security, will have to be 12%. But you decide to basically cap your payment. So let's say that you want a cap of 10%. You don't want your payments, your net payments, to be more than 10%. And if you recall earlier, a cap of 10% means that effectively you just want to pay 10% no matter what happens to the market rate of interest. So even if the rate goes up to 11%, you only want to effectively pay 10%. How can this happen? You can actually purchase a series of call options, interest rate call options, and to make it simple here, the series of call options here actually is just 2 call options. So you can buy one call option. So let's say when you issue this bond at time 0, you have one interest rate call option that expires at the end of period 1, and the strike price on this is 10%. And you have another interest rate call option that expires over here at the end of period 2, and here also on this call option the strike price is 10%. Now obviously you'll have to pay a premium for these options, but once you've paid that premium, you have essentially a series of calls. So this call over here which expires at the end of period 1 with a strike price of 10, and a second interest rate call option which expires over here. And obviously if you have a longer term bond, this could just go on. Now what happens? You get to the end of period 1 and now you are starting period 2. Interest rate is, let's say, 11%. Had you not owned this interest rate call option, you would have to you would make that 11% payment. But because of this call option, where you have a strike price of 10%, if the market rate is equal to 11%, overall, because of this interest rate call option, you have a benefit of 1%. So as the issuer of the bond, your floating rate payment is 11%. Your benefit is 1% because the market rate is higher than the strike price. So by owning this option, your net benefit is 1%. And when you combine your 11% cost with the 1% benefit, your overall cost then is 10%. When you get to the end of year 2, which is the beginning of year 3, if you had a pure floating rate bond, the payment you would have to make for period 3 is 12% because that is the market rate. However, you had invested in an interest rate call option with a strike price of 10%. Since the market rate is equal to 12%, here your benefit is equal to 2%. The rate that you have to pay on your floater for period 3 is 12%. The benefit is 2%. So again, the net payment that you make is 10%. Now effectively what has happened is, by issuing a floating rate bond and by purchasing the series of call options, you have effectively converted your floating rate security into, as in you have essentially given yourself a cap at 10%. The next point now is that interest rate floor is equal to a series of put options. Now take the perspective of a owner or a investor in a floating rate bond. So to keep it simple again, we have a bond that will make 3 annual payments. So this is period 1, 2, 3, and let's say this is a floating rate security. Initially the interest rate is 10%, so you are going to get a payment of 10% for period 1, and then obviously your payment for period 2 and period 3 will be based on the interest rate for period 2, interest rate at the beginning of period 2, and your payment for period 3 will be based on the interest rate at the beginning of period 3. You are worried now about interest rates going down, and what you can now do is buy a series of put options. So what does a put option do? The put option essentially means that you benefit when the interest rate goes down. Why? Because if you recall, the put option is the right to sell, in this case the right to sell money. So if you have a put option with a strike price of 10%, that means that even if the interest rate goes down to say 9%, because of this put option you will still get 10%. So if the interest rate becomes 9%, your net benefit because of this is 1%. Now let us say that in this example the market rate of interest comes down to 9%, but at time 0 you had invested in a series of put options. So one put option expired over here with a strike price of 10%, and the second put option expires over here with a strike price again of 10%. When you come to the end of period 1 or the beginning of period 2, if the interest rate is 9%, then on a regular floater as an investor you would have received 9%. However, since you have this put option, you have a net benefit of 1%. Remember that as the owner of a put option, or since you have a long position in the put option, you benefit when interest rate is lower than the strike rate. So your benefit here is 1%. The market rate is 9%. So from your regular floater you get 9%, plus because of the interest rate put option you get 1%, and your net benefit is, overall benefit is 10%. And at the end of year 2 or beginning of year 3, if the interest rate is down to 8%, the bond is going to pay you 8% for period 3, but because of the interest rate put option your benefit is 2%. Your overall rate then will be the 2% plus the 8%, which is 10%. So essentially what we have done as the investor over here, by owning this floating rate security and by owning these series of interest rate put options, we have essentially put a floor on our interest rate payment, and in my simplistic example the floor was at 10%. Here you simply need to recognize that interest rate collar is equal to a long cap plus a short floor. From an exam perspective, I don't think you'll be expected to show or derive this relationship, but very simplistically, let's say that you have issued a floating rate bond and you are concerned about the floating rate, so you want to put a cap. So let's say that you want to put a cap at 10%. So to put a cap at 10%, you go long on interest rate call options. So as we just saw, a series of interest rate call options would be a long cap, but obviously there is a cost involved to buy these interest rate call options. And let's say that you are concerned about that cost, and to offset the cost of buying the call options, you sell or go short on a series of interest rate put options. Now the series of interest rate put options that you are selling, obviously money is coming in, so ideally you could the money that you make from selling the interest rate put options could offset the cost of buying the interest rate call options, and that is sometimes referred to as a zero cost collar. But all you need to remember is you can sort of create an interest rate collar by going long on a series of interest rate options and going short on a series of interest rate put options. That's all you really need to know on this one. Currency options. So this is simply an option where the underlying is a currency. So take a very simple example. Let's say that we get into a currency option where the underlying is the US dollar. So a simple example of a European option in this context would be as follows. So we are at time 0, and in about 2 months, let's say 60 days, we want to be able to have the option of buying dollars for 90 rupees a dollar. So how would this be structured then? So at time 0 we pay a premium. So let's just say that the premium is rupees 3. So we pay a premium of 3 rupees to get the option of buying the underlying for 90. So the contract would look something like this. Your underlying is the US dollar. We can specify a notional principal of say $1 million, and the maturity or expires in 60 days. So we'd specify 60 days, and we would specify a strike price of, let's say, 90. Actually the maturity would be a specific date. Now a strike price of 90 means that the long party has the right but not the obligation to buy the underlying at this price. So in this example, the underlying is the strike price is 90 rupees. Now how will this work in terms of a simple payoff diagram? The strike price is 90 rupees. This is the strike price for the underlying. So if at maturity the dollar is at 92 rupees, then obviously this option will be exercised and will be of benefit. If however the dollar is trading for say 89 rupees at expiry, then the option will be out of the money. So it's exactly like what we have talked about before. The only thing with the currency option is that the underlying is a currency. Options on futures. Here we don't need to get into too much detail, but here the underlying is a futures contract. So if we are talking about say an option on a futures contract in cotton, now the strike price here might be say $1. What this means is that the long party has the right to get into a particular futures contract. So the underlying will be a particular futures contract. So this might be the July contract for cotton on the New York Board of Trade, to be somewhat specific. And a strike price of 1 means that on the expiry of this call option, the holder of the call option has the right to get this underlying contract for $1. So the interesting thing about options on futures is that even the underlying is a derivative. So in this case the underlying is a futures contract. So this essentially is a derivative on a derivative. I don't think it's too significant at level 1, but as long as you just understand the basic point that options on futures are exactly what the term implies, that this is an option to get into this is an option where the underlying is a futures contract. So that is it for this segment.